viewers, Salivate Metal here, and in life sometimes it's good to round your opinion by looking at the opposite spectrum and read articles and the like that counter your point of view so you can get an idea of what the arguments are. And so, as is the case here today, we have an article from MSN talking about 5 reasons not to invest in gold. So we'll take a look at this and read certain parts of this. It's basically from the point of view of Warren Buffett, and he says that the gold investors have a right to be afraid of paper money, but they say that they should invest essentially in the stocks, and there's going to be 5 characteristics to show that gold isn't a place to put your money, which is quite an interesting statement, which we will cover later. So the first one is poor long-term returns. Well, let's start with the biggest one. It says, investors are familiar with the phrase, past performance is not necessarily indicative of future results, which is a sober reminder that mutual funds and managed accounts tend to move back towards their average. However, the implicit warning holds less muster when looking at the performance of entire asset classes over time. This, says Robert R. Johnson, President and CEO of American College of Financial Services, is where gold's inferiority becomes clear. Johnson and his colleagues in the book Invest with the Fed, note that title, wrote that gold underperforms equities in all interest rate environments despite its celebrated popular status as a hedge against inflation. From 1972 through 2013, common stocks returned 14.68% of falling rate environments, while gold futures returned 7.85%. And so it mentions other numbers, basically saying that stocks outperform gold. And so it's interesting that they use the word invest, and they say that while its celebrated status as a hedge against inflation. So which is it? Is it a hedge against inflation, or is it an investment? It goes to show you that the John Devine, the writer of this article, doesn't truly understand gold, as Belange P. made a very articulate video describing as such. So there's that. It's talking about it as an investment. Well, none of us that are familiar enough with gold ever saw it as an investment. So that brings us to the second point. How do you value gold? The article continues, finance nerds will tell you that the value of any asset is the present value of all future cash flows. Old school Wall Street firms live and die by this concept, and many blue chip stock is bought and sold when the models are rigged and well-researched growth and interest rate assumptions flash buy or sell. Similarly, there are all sorts of ratios, price earning, price book value, price enterprise values, etc., to gauge a stock steal or a ripoff. Those metrics don't exist for gold. Tom Cassidy, Chief Investment Advisor of Univest Wealth Management Division. The value of a company can be estimated based on forecasts of future earnings and the growth of earnings. Gold does not have earnings, and in fact, if you want to hold physical gold, there is potentially a cost to hold and insure it. Gold is worth what people are willing to pay for it on that day. The value of gold is determined by supply and demand, which is very hard to predict. Demand typically goes up based on fear and not fundamentals. You can't exactly put a dollar figure on a fear index, can you? Well, that just goes to show you the paradigm of thinking. They're thinking of gold as a dollar amount attached to it, whereas in reality it should be the other way around. I always use the example that I tell people when they ask me questions about gold is you can take a $20 gold piece minted in 1899 and go down to, and by the way, take all the numismatic value out of that gold piece and go down to your local coin shop and sell that coin. And with the money from that coin, you can go into a nice tailor and get yourself a nice pinstripe suit. If you take that $20 gold piece in 1899 and go down to your local tailor, you can get yourself a very nice pinstripe suit. So I argue that it maintains its value. Now, there are fluctuations, obviously, for the reasons mentioned here. But by and large, the value of gold is intrinsic. In other words, it's innate within the metal itself by the very nature of the metal through the history of literally over 1,000 years, over 2,000 years. Moving along, gold doesn't throw off cash. There are no dividends. One of the best things about stocks is their ability to produce income for the shareholder over time. Not only do you get to keep your equity in a growing company, but you get to receive the dividends it pays out over the years too. Johnson puts the dilemma simply: a major disadvantage to investing in gold is that there are no periodic cash flows made to the investor. Unlike most stocks and bonds, there are no regular cash dividends or coupon payments made to gold investors. Also, cash isn't exclusively for dividends. It can also be used to buy back stock or reinvest in the business, neither of which apply to a non-producing asset like gold. Well, again, a misunderstanding of what gold is. Gold is essentially eternal. It does not degrade. It is treasured, which we'll talk about here in a moment. And it was never meant to be an investment vehicle. And the thing is, the dividends can dry up. Stocks can dry up. It's essentially a piece of paper. Those are perishable. Enron went out of business. Adelphia, all the other stocks that at one time were WorldCom were greatly valued. Now, where are they? Now, can that happen to Apple? Can it happen to Facebook? Can it happen to any other stock? Sure, it can. Now, it's relatively unlikely, but gold will never go away. It will never go to zero. It may not produce dividends, but it will produce security and preserve the wealth that you have. Little actual utility is the fourth reason not to, quote, invest in gold. And this is talking about what I've referred to before. So as the article continues, okay, so the famed precious metal doesn't throw off cash, but then neither does it provide much utility in the way of production value, says Andrew Channon, CEO of Pure Funds. In fact, gold isn't even the most useful precious metal, practically speaking. He's right there. Most gold that is mined gets turned into bars, jewelry, or coins and then stored in a vault. On the other hand, roughly 2/3 of silver produced goes to industrial applications such as solar panels, medical devices, and electronics such as computers and cell phones. So he's correct there. Silver is actually seen more as a commodity than it is money. However, that does not take away its properties as money, in my opinion. And we are seeing the price of silver climb after Brexit and the like, and I think that's part and parcel to some of what we are talking about here. So gold does lack significant industrial utility. However, it is treasured. It is treasured by not just those of us here in the West who understand its value, but a lot in the East and the Middle East. Gold is treasured. And for that property alone, that should tell you something. So, yes, it has no utility other than preserving your wealth. And I can't think of any better utility than to preserve my wealth. Inefficiency is the fifth reason. Boy, these people don't understand gold, do they? The final reason investing in gold simply isn't a wise idea, as it is extreme inefficiency. Since it's a physical asset that people have a tendency to hoard, there are storage costs and often security costs, as malcontents have a tendency to steal it. Well, that proves my point. Malcontents understand the value of gold. It's too bad that John Devine and the people at usnews.com and MSN don't. In an ironic twist, the very metal that's supposed to safeguard investors from runaway inflation and a print-happy Federal Reserve is also constantly experiencing an increase in supply. Well, more and more, after all, it's mined every year, increase in the world's usable gold supply. Well, there's a simple answer to that, and that is you can't just digitize and print gold. It takes a ton of earth to create an ounce of gold, approximately. And it's becoming less and less. So yes, there is an increased supply of gold every year, but it's minuscule. It is absolutely minuscule compared to the derivatives that are out there and the quantitative easing and everything like that the the Keynesians want to throw at us. And then there's the whole tax thing. Oh boy, sell all your gold because of the tax thing. Tom Cassidy gets into it. Gold's return is solely based on the price going up. Thus, when you sell gold, you create a capital gain. That in most cases will be taxed at the more favorable capital gains tax rate. And of course, there's ways around that very easily that you can get around that unless you're buying kilo bars at a time. However, if one invests in gold at a tax-deferred account, the gains one receives will be taxed based on their income tax bracket, which is typically higher than their capital gains rate. So if an investor does want to own gold, it should be done using taxable assets. All in all, gold is tricky for investors. And again, they think that we're investors. We're not investors when we collect gold and silver. Does it provide diversification? Sure. Can it be thought of a currency? The fact seems almost undeniable. And of course, I'll interject here is that it's not a currency. Gold is not a currency. It is money. There's a huge difference. Its fungibility that makes that difference. Does it hedge against inflation, provide a viable long-term investment alternative to the stock market? Not by a long shot. Warren Buffett is a stock man. And so this is where he basically ends his article with a crescendo saying that does it provide a long-term investment alternative to the stock market? It is not an investment. So that argument is totally moot. It is a hedge against inflation. So I hope you enjoyed this video, and it's always good to look at the other side and see what they're saying. And it's so easy in some of these cases to debunk the myths around gold. So I encourage you to watch Belange P's video, Understanding Gold, to further bolster my point. I'd like to extend a multitude of gratitude to you all for watching, and encourage you to please rate, comment, and subscribe.